So chapter 15 is about accounting and taxation and global business. The accounting part is a little bit similar to a general accounting lecture, just to refresh and remember what accounting, what's the purpose of accounting and what are some of the major functions, right? So accounting is the language of business. You really don't know how a business is doing until you see the numbers. You know, we might hear about a business, about their marketing, their campaigns, their ads, their great products or services. Everybody knows them, everybody loves them, but until we see the number, we don't know how the business is doing, right? Accounting is recording, summarizing, and recording and reporting of economic activities and events in an organization. It's used to make business decisions, and it's essential for managing and controlling operations, right? You got to know what's coming in, what's going out, what are you making, what are the money makers, what are the losers, and what's my budget, how much more money do I need to add something, and so forth, right? Financial statements are the most important reports produced by accounting information systems. What kind of financial systems come to your mind when you think about accounting or financial statements? Ellen, yes.
Statement of cash flows.
Cash flow statement. Cash flow statement is the cash that comes in and out during a certain period of time, right? If you look at your bank account and you see what did you get, what did you receive, and what went out, what did you pay? What other statements come to mind? They're really important. Ellen?
Balance sheet.
Balance sheets, yeah. And I'll go. I guess I will go over it briefly since I didn't look at the slides. I don't remember, but I'll go over it. A balance sheet gives you a snapshot of a moment in time. What's your company worth, and what's your debt? How much do you owe, and how much do you own, right? And let's do one more statement. That's really important. Ellen.
Income statement.
Income statement, yes. I mean the three main statements.
Maybe annual report.
Well, that's for large companies and things like that. You can use.
It depends.
You can use annual income statements. Smaller companies.
Some investors asking this.
Investors, yeah, but let's
due
think.
diligence process.
Yeah, but we're keeping it simple right now, right? Yeah. So at the bare minimum, every company should have these three statements, right? Even if you're a tiny business, you should have this statement. Income statement shows how much revenue are you getting and what are your expenses, and do you end up with profits or losses, right? It's also sometimes called P&L or profit or loss statement. Profit and loss statement.
Because of Sarbanes-Oxley, like we legally have to keep track of that information.
Public companies have to keep track of it because of the Sarbanes-Oxley Act in the United States, right? Publicly traded companies, right? It's smart if all companies keep track of it, because for governance purposes or audit purposes, the IRS might audit you. If you don't keep track of it, you can't prove your expenses, for example, right? Anyway, so let's go over it really quickly. There's one more statement of retained earnings, but income statements is how much did the firm earn or lose from operations during a certain period. So let's say we're using a monthly period. Let's say we are selling, what are we selling today? What's it?
Bicycle.
Bicycles. We're selling bicycles. How much are they? Per bicycle. There's a large range, right? You can get anything from $200 to $20,000 probably, right? Let's do one we can sell a lot of. Maybe $500.
Yeah.
How about $500 bicycle? The lowest end specialized bike or something like that, right? They probably are not even 500 anymore, but let's say we're selling for $500. Let's say we're selling 1,000 bikes in a month. At $500, how much revenue do we have?
500,000.
500,000, right? Wow, that's a lot of money by selling 1,000 bikes, right? Yeah. Okay, how much did it cost you to make each bike?
It's a great question.
What's the markup?
200, let's say $200. It costs us $200 to make a bike. So per bike, we are making a margin of $300. So cost of goods sold, what does it cost us just to make the bike, not to run the company, right? So $200, so that means each bike gives us $300 of margin, gross margin, right? So total, since we're selling 1,000, so we have $300,000 gross margin now. Now we have to look at our operating expenses, because we don't get to keep that 300,000. What did we spend besides making the bikes? What other expenses do we have that are also called operating expenses or fixed expenses that don't change over time. Diego,
Utilities.
utilities. What else? Rent,
Insurance.
insurance, administrative
Employee
expenses.
wages.
Yeah, salaries and wages, right? They don't change regardless. You know, you have a bike shop, doesn't matter if you sell 1,000 bikes or one bike, you have to pay your rent, the same amount of rent. You have to pay utilities, you have to pay employees. You may lay off employees if you only sell one bike a month, or you might actually close your business. But you get the point. You subtract that. Let's say our operating expenses are how much a month for a bike shop that sells 1,000 bikes? $100,000 maybe?
Another 200,000.
100,000?
I don't know, that's a lot of money, right?
That's a lot.
50 maybe.
You could probably have 3 or
You can
4
freaking
employees.
20,000, even in.
That sells 1,000 bikes a month, that's a lot of bikes.
It's like
And maybe you
warehouse.
have like 50 employees and you need a big warehouse.
Uh-huh.
I don't know,
Outside of
let's,
of the city.
let's say just for the, $80,000. Your operating expenses are $80,000, so now how much profit are you left with at the end? So we have $300,000 gross profits, right? Now we're taking off $80,000, so we have $220,000. That's our net income before taxes, right? Statement of retained earnings is one we didn't mention. In what way did the firm's retained earnings change during the period? What are retained earnings? Ellen,
It's basically the money the firm keeps after paying its shareholders their dividends. Like the money that stays
Yeah.
in the firm after a year.
yes, so after they pay the shareholders dividends, which else, actually the board decides what they're going to pay their shareholders. But so how much stays from the profit, and we made 220,000, how much are we going to give to the shareholders? And how much are we going to keep in the company to maybe grow it? Right, so let's say we give $100,000 back to the shareholders. And that's a lot of money in a month, right? It's unrealistic numbers, obviously, we're doing today, we're just pulling them out of our pockets without thinking, but anyway, so you look, you state the beginning earnings plus net income or net loss minus dividends, so after you pay the shareholders, and then you end up with your retained earnings, right? You need a statement of that, right? The balance sheet is assets, so everything you own versus liabilities and owner's equity. I wonder if I have slides. I mean, if I have samples on the next slides. I apologize again for not looking. No, I don't. Okay, so I can explain it from here. I just didn't want to talk too much. And it's not an accounting class, and I do explain this in my intro to business class, but when you're in this class, I assume you already know the basic stuff, right? But a balance sheet, so basically assets, so we're a bike shop. What are our assets? What are the things we own that are worth money? Diego,
Equipment.
equipment. What kind of equipment do you have in a bike shop?
Well, I mean, we're manufacturing them, right?
Let's just say we're a store, keep it simple.
Oh, we're distributing.
We're just
selling
doing-
them. So I guess equipment would be like to like maintain the bikes in condition so they can be sold in neat condition, like pumping up tires.
Yeah.
Like waxing, I guess.
Yeah, maybe we have some service too. Your red,
Helmets.
helmets is not equipment
Yes,
because you are
inventory.
selling the helmets.
Yeah.
That's inventory, right?
It's even like a side business.
Well, if you sell it at the bike, yeah, it's a side product that you also sell besides, yeah. I thought you were gonna say something, no? Okay, so, equipment could be your computer equipment, your register, that kind of stuff. That's all worth money, right? Your,
All IT stuff.
yeah, IT stuff, right? Yeah. What else is an asset? Diego.
If you own the building.
Oh, yeah, real estate could be an asset, definitely. That's a huge one. Ellen,
Even if you don't own the building, your prepaid rent is usually written as an
prepaid
asset.
rent, prepaid leases is an asset. Anything prepaid is an asset, right? Prepaid insurance is often an asset, right? What else could be an asset? A bike shop, a big one. So the ones we mentioned so far are fixed assets, building, equipment, prepaid stuff. we can't convert those into cash easily. Then there are assets that you can easily convert into cash that are not fixed assets, are what? What's one of the big assets a bike store has?
The bikes?
The bikes, yes, the bicycles, inventory, right?
Yeah.
Maybe I'll add to that helmets and tires and things like that, Diego.
The literal cash.
Yeah, the cash in the bank is definitely a very liquid asset, right? It's a very liquid asset. Cash is the most liquid form of an asset. It's already cash, right? Or things that can be easily converted into cash. Usually inventory is because you sell it and it becomes cash, right? Yeah. Anyway, that's the assets. That's on one side of the balance sheet. On the other side of the balance sheet, you have liabilities and owner's equity. Liabilities are the things you have to pay other people. So your loans. Maybe you opened the bike shop a year ago and you still have $500,000 in debt because you bought the building or something like that, right? So that's a liability. There are short-term and long-term liabilities, by the way. Short-term ones are the ones that you pay off within a year and long-term within more than a year. So a real estate liability would definitely be a long-term liability, right? And then other liabilities. Liabilities are not the monthly bills you pay, like your rent and things like that. That's operating expenses. Don't confuse it with that, right? That's not a liability, that's an operating expense. Liability is pretty much debt, right? So, and owner's equity is, let's say the building is worth $1.5 million. And so you have $1 million equity now.
Revenue and expenses is included in that.
It's not like revenue and expenses is included, but every time you do a financial transaction, your balance sheet can change. Like you made a loan payment.
Yeah, the accounting equation is assets equals liability plus like I think it's the stocks you earn minus dividends plus revenue minus expenses.
You lost me there.
Okay, just the accounting equation.
Which one? For the balance sheet?
Yeah, no, I mean for the balance sheet, the one that expands on
This
the
one,
equity.
no, this one is this is it.
Yeah, it's just equity is expanded. It has more stuff in it.
Equity expanded,
Yeah, so it's like the stocks you get minus the dividends that you pay out plus the revenue minus the expenses.
so if you want to explain owner's equity further,
Yeah.
you mean, okay, yeah, we're not gonna go into that detail.
Revenue doesn't show up on the balance sheet.
Huh?
Revenue is.
Revenue does not show up, no. No, the only way revenue technically shows up, it doesn't really, but let's say you just sold 10 more bikes. So instead of listing the bikes as inventory, now you have it as cash. But revenue is not part of the income statement. Neither are your monthly expenses. I mean, I'm sorry, balance sheet, not income statement. Revenue is not part of your balance sheet. Right, yes,
I mean, just like nitpicking, but your expenses could be on your balance sheet if you have not yet paid them. So like the
but
expenses
they're
you
not
accrue
listed
are.
as a bill you
They're
have to pay.
liabilities,
and-
so as you accrue them, right? Like your
Yes.
accounts, they're
Accounts
considered accounts
payable,
payable.
accounts payable, yes, exactly. It's accounts payable, yes, that's right. But they're not like listed as in the form of the income statement,
Right.
right? And then as you pay them off, they disappear and then they could add more. You know, like I said, you pay a loan, then you pay your loan off. You may have
Yeah.
less cash now, you took out cash from there, but you paid your loan off.
The thing that I mentioned was that like retained earnings.
You were looking at the one, that's the retain, statement of retained
Yeah, but
earnings.
that funnels into owner's equity.
Oh, yeah, yeah,
itself,
of
so
course,
yeah,
retained
it's-
earnings.
it's all connected.
And then statement of cash flows, Adam mentioned earlier, it's what amount of cash was generated and spent during a certain period, right? So we just said we sold, how many bikes did we sell? 1,000 bikes at
500.
$500, so we had $500,000 cash inflow from the sales of bicycles, or sometimes they call it operating expenses, right? Cash inflow from operating expenses. And then cash that goes out to your employees, your rent and insurance and this and that, right? Why is it important to keep a cash flow statement? Ellen?
If you run out of cash, you cannot pay your workers, even if your company has turned a profit.
Yes. You could be highly profitable, but you can run out of cash, which can put you in trouble, especially if you can't pay your bills or first and foremost your employees. Now you have to borrow money, probably at a very high cost just to pay your employees, yeah.
You can also identify if you have any extra things that you need to cut down on. So like if your variable costs or your fixed costs seem certainly high, then you can identify that, like that's cutting into your overall profit.
Yeah, you would catch that in the income statement if your variable expenses, you said variable are
Mhm.
high. But you know what so the cash flow statement is a result of that, right? But what the cash flow statement can make you maybe try attempt to do is when the time you pay your bills or the time your customers pay you and time it right, that things come in time before you have to pay your stuff, right? Or, you know, a lot of times companies, when they do contracts, business to business transactions, they give you a discount if you pay ahead of time, right? They give you 2% discount, sometimes 5% even, right?
Penalties.
It's cash flow. Tazu, you were gonna say something?
Yeah, I was gonna say is interesting about the the generated spending and the company that I was like there was a period where I was listening to a bunch of podcasts from like various businesses and stuff and business owners. It was really interesting. The company I work for now, they were saying how they had to lay off like 200, 400 employees at like the beginning of the pandemic because they knew that they didn't have enough cash to keep paying all those people, even if they were to have them like even just to have them on standby. They didn't have and they knew that they would be able to generate enough revenue to keep paying all their employees.
Yeah, I think at one point, if they make a decision that they can do just the same without those employees,
Yeah, so
cutting costs.
yes, they said they had to lay off like 400 people in one day, and then put all of the stores into like hibernation, I guess.
Oh, so it was like a retail chain, huh?
Yeah.
Yeah,
Mm.
yeah. And then how did they come back? Just with less staff, maybe?
I think no, I think they came back with like they had to like rehire and rebuild a lot of the stores and stuff. And I think part of it was they came back like kind of slowly, like they tried to bring people back as soon as possible. I think they had some small business loans as well that kind of got them through it. And also like generally they were lucky in that people still wanted the product during the pandemic, so they were able to get some business.
Oh, this was during the pandemic, yeah, that's very common, so that was not very rare occasion, obviously, a lot of stores had to do that, right, yeah, because they can't generate the cash flow to pay them, right? The stores had to be closed, they couldn't even open for operations, right, yeah, so. Anyway, so now that's kind of what we just covered, every company has to do, global or not, right? You gotta know what's going on financially in your company. But now let's talk about accounting and financial reporting in the global business, right? You still have to do your financial reporting, but one of the things that's being used is accounting information systems. It has two principal objectives: provide all the financial information internally needed by management for business decision making. It's also known as management accounting or managerial accounting, they call it, right? That's what we call it here in our campus. That's what the courses are called. It's managerial accounting, right? Or provide financial information to various external users, such as shareholders, investors, banks, the IRS, and stuff like that. And that's financial accounting, right? Bless you. Management accounting provides, this is just a repetition, provide information timely and effectively and accurately, most especially, to internal managers to make decisions. And accounting firms include information such as cost, volume, profit analysis. What is our cost at what volume? If we buy 1,000 bicycles a month, we have to pay $200 a bicycle, and we can sell 1,000. But if we buy 2,000 a month, our cost goes down to maybe only 180 a bike, but we can still sell it at 500, and maybe we can sell 2,000. So all these things you have to analyze and make decisions based on that, right? Capital budgeting, inventory planning, you know, right now, retail stores are doing heavy inventory planning because of holiday season, right? It's in retail industry, in certain retail industries, a lot of it is very, very seasonal. Clothing is seasonal, right? Vacations seasonal, you got summer vacation, summer clothing, summer sports, you got winter vacation, winter clothing, winter sports, right? So, and you have to plan your inventory accordingly. There's sophisticated technology that has had an impact how management accounting tasks are performed. It's not manual anymore. You gotta know how it's, you have to know how the equations work and everything and what they mean and how to analyze the information. But the information is collected through accounting information systems, right? Same with, you know, if you're a global company and you have revenue from another country and there's an exchange rate involved, all that is converted automatically through these systems. And financial accounting, as we said, it's used for external parties such as lenders, investors, and so forth. Organizations, so two major categories: organizations that require or expect information to be reported, like if you're a public company, the SEC, Security and Exchange Commission, right? IRS for anybody. Organizations that receive information on an as-needed basis, investors and things like that, right? And then there are organizations that acquire, oh, okay, actually this, I already mentioned that, the federal, state, and local governments for tax purposes. And then also organizations that expect accounting information include lenders, credit rating agencies, suppliers, employers, customers, and so forth. I think it meant employees, not employers. I don't know why it said employers. Employees sometimes need access or should have access, right? To some.
If
I'm not
you're in a co-op,
Yeah, go ahead.
if you're in a co-op, then the employers would have to have access.
Yes, if you're in a
because they
co-op,
make the
yeah.
decision.
And if employees get stock options of a company that is not public yet, they would have access to that information. Otherwise, the stock options would be meaningless, right? I mean, again, this are some external users. We kind of went through them. Why customers? Well, customers only need to know their part. How much do they owe? How much interest is being charged if it's something that interest is charged and things like that, right? Customers don't have access to other parts. So you can limit who has what access. You know, suppliers only need access to a certain part. Your customers only need access to a certain part. Employees don't need company-wide access either, right? Lenders and your lenders and shareholders probably do need more access than your customers, for example. Anyway, read those on your own. I'm not gonna just read them to you. Generally accepted accounting principles was used in the past. Financial statements of publicly traded companies must be prepared through accounting, follow a certain accounting procedure called GAAP. It's been replaced by something else now. I forgot what the new one is called.
For public companies?
Yes. It's not GAAP anymore. It's called something else now. Each country in the world has its own practices though. So that's one thing that makes it a little more complicated when you're a global business. If you could look it up and let me know when you find it.
US still uses GAAP, but
US still uses GAAP?
yeah, there is an international one.
Oh, okay. Differences in cultures and business environments have led to differences in accounting principles among different countries, so.
I think it's IFRS, the International Financial Reporting Standards.
IFRS, International Financial Reporting Standard
Mhm.
for global, okay, thank you, yeah. So GAAP is a little outdated, but I thought it was outdated long before this textbook came out, but they still use it, right, yeah. Anyway, differences in GAAP in other countries made it difficult for investors and financial users to compare reports, right? Because every country has different standards. That's why they adopted this general standard that is used, IFRS, International Financial Reporting Standard, that they're all
Mhm.
complying with that now, so it's easier to analyze information across different countries. So as an independent, privately funded accounting standard setter, it's based in the UK that issues these reporting standards. right? So they have a board that regulates these standards and that you can probably complain to. The objectives is increases harmonization in accounting standards, provides an accounting basis for underdeveloped or newly industrialized countries to follow. So when they do start doing business more globally, it'll be easier for them if they already start applying these principles, right? So they encourage and support that. And increasing compatibility of domestic and international accounting requirements for auditing for audited financial statements. So it makes you more competitive. Yes.
So we were talking about previously about companies acquiring local assets in order to make a base of business. So when they do that acquisition, do accountants come in and like reevaluate every single like financial stuff, but in their principles instead? So like, for example, like a US company would evaluate it in GAAP instead of
They would have to evaluate it in whatever reporting standards the reporting
Okay.
company did. Otherwise, they would have to convert it first, that's extra.
Yeah,
Work,
they
right.
just have to keep the data according to the standard,
they
Yeah.
just keep the
nothing special.
they
Yeah,
don't change it.
yeah. No, and then
If
you
you don't change
evaluate.
it, It's illegal.
Yes, exactly.
No, I mean like
You mean the standard, like convert it into a
yeah,
different
like
system?
make the
No,
financial
you would
statements
just,
the way that the
no.
principles would be in the home.
You would look at whatever it was originally reported, and that's what you want to
Got it.
analyze,
So
right?
you just need people who understand that.
Yes, that's right. Exactly, yeah. That's why it's easier to apply the international standards, regardless of whether you're global or not. And let's say you start a company and you don't apply them, but then 3 years later you go global and now you have to change your whole system. So why not, especially it's like a couple of slides ago, it said developing countries or newly industrialized countries are encouraged to apply those standards, right? So Sarbanes-Oxley Act, what do you all know about Sarbanes-Oxley Act? And why do we have it? Since when do we have it? Yes,
Oh,
Diego,
you know this case?
Kind of, yeah.
Enron.
Yeah, Enron.
Yes,
This is the
exactly.
one with the famous.
Oh,
You wanna-
Enron.
I think there's a movie.
Yes, there
Really?
is. There's an Enron
I didn't know
movie.
about that.
It's, yeah, watch it, Enron, yeah. Enron, this was happened in 2000, I think, or 2002, something like
Even earlier.
Yeah, it was after the dot-com crash, right?
2000
Had
probably,
the-
that's
so I think it's the Sarbanes-Oxley Act of 2002.
2002 is when the act
Mhm.
came out, so it
And
probably started,
they added to it, right?
Maybe.
well, they keep changing and adding and things
Yeah.
like that, right? But basically, because of the scandal we had with Enron, which was a utility company, powerhouse, it was a powerhouse that cheated and falsely reported, cooked the books, they call it, right?
Mhm.
They reported something else than the truth. So people kept investing and thinking they're doing well. And this included individuals who had their 401ks invested in that company and things like that, that now, as a result, couldn't retire.
It was,
Yeah.
it was the biggest accounting firm in
Scandal.
the country.
Oh, you knew Arthur Anderson was their accounting firm and did it with them and helped them
Yeah.
do it, right? So it all blew up and people went to jail. Arthur Anderson ceased to exist and all that stuff, right? But because of that, we have the Sarbanes-Oxley Act, and it's very interesting. You should look into, at least maybe read a summary about it. We're not going to go into detail, but they assure that financial statements do not contain material misstatements, either intentional or unintentional. Material misstatements means the wrong numbers, right? That's financial statements use numbers. So if you have 10 million in earnings, you can't say you had 12 million in earnings, right? Things like that. Financial statements are fairly presented according to generally accepted accounting principles or standards, general standards. So people understand them too. This is for publicly traded companies, not for private companies. Audits, financial statement audits, objectives is confirm existence of assets and liabilities and income and expenses. So kind of reviewing the statements we discussed, income statement and balance sheet. Assess the completeness of financial statements, are all assets and liabilities, income statements and things like that present or accounted for. Who might do an audit?
The IRS?
The IRS, that's right. If they're suspicious that you cheated on your taxes, and they can even do it on individuals, right? But they go after a lot of companies. And you were saying
Investors.
investors, yeah,
That's
investors.
the first.
Yeah, even more, right?
Yeah.
Shareholders, I mean, they have to be, public companies have to have independent audits.
Even not public, even if
You,
are
you should
startup,
even, yeah, any.
It's better
company.
for you.
Yes, yeah, it would be good, you know, it's a good practice to have for any company, yeah. Ensure proper valuations of asset liabilities and so forth. Show that the auditee owns the assets and is obligated to the extent of what the liabilities show. And assure that financial statement items are properly presented and disclosure regulations have been followed. So make sure that laws have been followed, right? This is again, a little more details about the Sarbanes-Oxley Act. I'm not going to go over that. Just one more slide, global tax matters, you know, things you need to consider, the type of taxes. Of course, income tax, any company has to do that. Sales tax is different in different countries and it's collected differently. In the United States, when you buy something that costs $10, that's subject to sales tax, you pay $11 at the register. In most countries in the world, the tax is already included in the price that you see. However, the tax is higher, between 18 and 22% easily. If we think we pay high sales tax, it's VAT, value added tax, that's why they call it in other countries, right? It's average 20%, right? But it's already included in the price. Doesn't mean we're cheating. Actually, in a way, I kind of like this system better because I know what goes to that company and what goes to the government. And if I have a business, I can expense stuff differently, right? So sales tax, you have to consider that. Property tax, United States has typically very high property taxes. When you own property, you pay property tax. California is actually low as far as percentage. If you go to states like Florida, their property tax is like 4 or 5%, right? So if you have a house that's $1 million, you pay, what is 4%? $40,000 a year in property tax. That's very high. In California, you pay something like 1.25 maybe, or 1.5. 1.7, anyway, 17,000, 18,000, something like that. The only difference is real estate is more expensive here than in Florida. But, you know, and globally is different. A lot of countries don't have high property tax like here.
But the cool thing about California property tax, I don't know if it applies elsewhere, is that it's capped to grow at a certain amount.
Mhm.
Yes.
So if you buy your home at a low price, that's the first
That's right.
basis for assessment. So your taxes will stay low as the value of your
So,
home
yeah.
rises.
And I benefit from that because I bought my house 20 years ago. And it's worth more now, and I pay taxes just a teeny bit increase, yes.
Also, what kind of makes up for it is like Florida has no state income tax.
Yes, that's right. They have other advantages. California has very high income tax. Yes, that's a good one. Anyway, but you have to consider property tax in other countries when you own real estate. Payroll tax can be higher in other countries, right? Goods and services tax. Well, that's, you know, service tax, like if you go to a restaurant, you don't just pay sales tax, you pay service tax, hotels and things like that, right? That's different in different countries. Oh, oh, no, never mind. Value added tax is actually sales tax, so that's what they call it in other countries, right? And corporate income tax, right? If you have a location in another country, you have to pay taxes in that country, end of story. Right? All right, I am going to stop here. And stop the recording.